Picture this: New York City, fall of 1929. A man walks into his bank on a Tuesday morning with a feeling in his gut he can't shake. Everything looks fine on the surface. Stock markets are soaring. People are celebrating, but something feels wrong. He requests to withdraw his entire savings, $12,000 in cash, walks out with a briefcase full of bills. Just 48 hours later, the world changes forever. Markets collapse, banks shut their doors. People lose everything overnight. But this man, he's safe. He has his money in his hands, ready to weather whatever storm is coming. Now let's fast forward to today, to right now in 2026. You get that same feeling. Something's wrong. You want to protect yourself just like that man did almost a century ago. You log into your retirement account, see $180,000 you've saved over 20 years of hard work. You click the withdrawal button and then reality hits you. A penalty calculator pops up on your screen. Federal taxes, state taxes, and a 10% early withdrawal penalty because you're not 59 and a half yet. That $180,000 just became $98,000, and you haven't even received a single cent. But here's the part that should terrify you. Even after accepting those brutal penalties, your money doesn't arrive immediately. Your withdrawal request enters a processing queue. 7 to 10 business days if everything's running smoothly. And during a financial panic, when millions of people are trying to do exactly what you're doing, those systems don't just slow down, they freeze completely. Not because your bank is going bankrupt, but because the entire financial system was specifically designed to prevent you from doing what that 1929 businessman did. The system was built to stop you from escaping. This is the critical difference between what happened in 1929 and what's about to happen in 2026, and almost nobody is talking about it. It's not just that another market crash is inevitable. It's that when it finally arrives, you won't have the ability to do what previous generations could do. You can't just grab your money and get out. Your wealth sits locked inside a complex system filled with time delays, penalty barriers, and legal restrictions that slam shut the moment everyone tries to leave at once. Every single mechanism that traps your savings was built deliberately, and not to protect you. It was designed to protect the system from you making the rational choice to save yourself when disaster is approaching. The 1929 crash destroyed lives because of reckless speculation, dangerous leverage, and mountains of debt. The 2026 crash will be catastrophic for a completely different reason. Digital cages that prevent escape even for people who can see the danger coming from miles away. Let me break down how we ended up here, why these traps are tighter than they've ever been, and why what's coming in 2026 makes 1929 look like a practice run. The 1929 crash ruined millions of people, but it had one critical feature that today's system has completely eliminated: immediate access to your own money. Understanding what we've lost is essential to seeing the danger we're facing now. Back in 1929, your savings account worked in a beautifully simple way. You walked through the doors of your bank, handed over your passbook with its handwritten entries, and asked for your balance. The teller opened the drawer and counted out your cash right in front of you. Same-day withdrawals of your complete balance were completely normal. No processing periods, no approval workflows, no reviews for suspicious activity. If you wanted your money, it was in your hands within an hour. Owning stocks was just as straightforward. When you purchased shares, you received physical stock certificates. These were elaborate paper documents with your name printed on them and the number of shares you owned. These weren't digital entries in some database somewhere. They were actual property that you physically held in your possession. To sell your shares, you could find a buyer yourself, hand them the certificate, and receive payment directly. Or you could go through a broker and get settlement in 3 days. Not 3 weeks, not subject to trading halts that can freeze you out. 3 days, consistently and predictably. This meant investors who sensed trouble brewing in September 1929 had real options available to them. They could liquidate their positions, pull money from their banks, and convert everything into cash or physical gold. Plenty of people tried to do exactly that. The problem wasn't that the system prevented them from escaping. The problem was that most people simply didn't see it coming until it was already too late. When the crash finally hit on October 24, 1929, the people who had positioned themselves in cash and gold made it through. The ones who hesitated, who believed the reassuring statements from experts, who waited just one more day to act, they were wiped out completely. But their destruction came from their own decisions and timing, not from the system physically blocking them from taking action. Banks that collapsed didn't freeze customer accounts beforehand. They didn't impose withdrawal limits or require supervisor approval for large withdrawal requests. They simply ran out of money because too many depositors tried to withdraw too quickly. That's a classic bank failure, and it's absolutely brutal. But it's fundamentally different from what we're dealing with now. Even margin calls back then were completely transparent. You had borrowed money to purchase stocks, maybe putting down 10% and borrowing the remaining 90%. When your stocks dropped in value, brokers demanded you add more cash to your account. If you couldn't come up with the money, they immediately sold your stocks to repay themselves. It was harsh, it was instant, but it was transparent. You knew exactly where you stood at every moment. Compare that brutal honesty to today's retirement accounts where your money sits locked behind penalty walls until you reach 59 and a half. Compare it to modern banks that can freeze your accounts for suspicious activity if you try to withdraw too much too fast. Compare it to investment funds that can legally suspend all redemptions during periods of market stress. The generation that lived through 1929 faced an absolutely devastating crash, but they weren't facing a system that was specifically designed to trap them inside. We are facing exactly that. After the disaster of 1929, regulators didn't just work to prevent another crash from happening. They constructed something far more ambitious. They built a financial system that could prevent ordinary people from escaping during a crash. Every major financial reform implemented between 1933 and 2010 had the same underlying goal: eliminate the ability of regular people to trigger bank runs and market panics by withdrawing their own money. The first cage was the 401k retirement plan, created in 1978 and marketed to you as a tax advantage. But look carefully at what it actually created. $7 trillion of American retirement savings locked behind walls of penalties. You contribute money throughout your entire working life, but you cannot access it without paying combined penalties and taxes that typically consume 35 to 45% of whatever you try to withdraw. But those penalties are just the first lock on the cage. The second lock is time itself. When you submit a 401k withdrawal request, you don't receive your money instantly. Plan administrators have to process your request, which takes 7 to 10 business days under normal conditions. During periods of market stress when everyone is trying to withdraw simultaneously, those timelines stretch out indefinitely. Some providers can legally suspend withdrawals entirely, citing administrative review or uncertainty about plan valuations. This actually happened during the 2008 financial crisis. Fidelity, one of the largest 401k administrators in the country, suspended certain withdrawal requests for weeks. Participants logged into their accounts and found messages saying their requests were temporarily unavailable. Their money was sitting right there on the screen, but they couldn't touch it. Not because they didn't have the funds, but because the system includes gates that automatically close during periods of volatility. Then there's modern banking itself, which has quietly restricted cash access over the years. Try walking into your bank and requesting to withdraw $10,000 or more in physical cash. Federal law requires banks to file a currency transaction report with the Financial Crimes Enforcement Network. Banks also have the discretion to delay your withdrawal for a suspicious activity. Review if they determine your request is unusual for your account. Daily ATM limits typically max out at $500 to $1,000, which means even if you have $50,000 sitting in your checking account, physically accessing that money would require 50 to 100 separate transactions spread over weeks or even months. By the time you could extract your own funds, the crisis would already be over and your wealth would be gone. But the most devious trap of all exists in investment accounts, mutual funds, exchange-traded funds, and brokerage holdings. Most investors have absolutely no idea that their ability to sell depends entirely on market makers maintaining liquidity, and that liquidity vanishes precisely when you need it most. During March 2020, over 200 exchange-traded funds were trading at 10 to 20% discounts compared to their actual underlying holdings. Your $100,000 ETF position was only sellable for $80,000 to $90,000. Not because the underlying assets had fallen that dramatically, but because the market structure itself broke down completely. Mutual funds have even more explicit traps built into them. SEC Rule 2(2)(e)(4) allows funds to maintain up to 15% of their holdings in illiquid assets. When those thresholds are breached during a crisis, funds can suspend all redemptions entirely. This isn't some theoretical possibility. It happens regularly. The Woodford Equity Income Fund in the United Kingdom suspended redemptions in June 2019, trapping £3.7 billion for over 3 years. When redemptions finally resumed, investors received roughly 70 cents for every dollar they had invested. Real estate investment trusts did the exact same thing during 2008 and 2009, suspending redemptions for an average of 18 months. Private equity funds have standard 7-year lockup periods with absolutely zero early withdrawal options under any circumstances. Every single one of these restrictions was sold to the public as protecting investors or maintaining market stability, but the actual effect is identical across the board. Your money is no longer accessible on demand whenever you want it. It's accessible on the system's terms according to conditions that can change instantly during crises. The 1929 investor could grab his cash and run for safety. The 2026 investor will click the withdraw button, see a loading screen spinning endlessly, and discover their request is pending, subject to delays or complete suspension if conditions continue to deteriorate. By the time access is finally granted, if it's ever granted at all, the wealth they were desperately trying to protect will have evaporated into thin air. These mechanisms exist right now in this very moment, embedded deep inside every retirement account, every bank account, every brokerage account, and investment fund. They're sitting there waiting patiently for the moment when everyone tries to use the exit door simultaneously. That's when you'll discover the exits were never real. The traps have existed for years, but 2026 is when they become absolutely catastrophic. Not because the mechanisms themselves have changed, but because of what's lurking underneath them. Unprecedented levels of debt, algorithmic trading systems, and a Federal Reserve that has already fired every bullet it had. Start with leverage, the amount of borrowed money in the system. Back in 1929, investors could purchase stocks with just 10% down, borrowing the remaining 90% on margin. That 10-to-1 leverage ratio meant a 10% market decline could completely wipe you out. Regulators raised margin requirements to 50% after the crash, thinking they had solved the problem permanently. But today's leverage doesn't live in those visible margin accounts anymore. It lives hidden inside derivatives, collateralized loan obligations, and private equity structures, creating 20 to 50 to 1 leverage ratios that are completely hidden from public view. When that leverage starts to unwind, it won't happen gradually over months like it did in 1929. It will happen in a matter of hours as computer systems execute pre-programmed selling strategies automatically. Unlike 1929, when selling stocks meant human beings physically shouting orders on a crowded trading floor, today approximately 70% of all trading volume comes from algorithms executing millions of trades every single second. These algorithms automatically sell when volatility exceeds certain thresholds, when momentum breaks through key levels, when correlations indicate systemic stress. When one algorithm starts selling, it triggers others in a cascade effect that moves faster than any human being can possibly react to. We saw a terrifying preview of this in March 2020. The S&P 500 dropped 34% in just 23 days, the fastest bear market in recorded history. Trading was halted multiple times by circuit breakers that were specifically designed to let cooler heads prevail and restore rational thinking. But those halts didn't actually stop the selling pressure. They just compressed it into smaller and smaller time windows, creating even more violent price moves every time trading resumed. Now imagine that exact scenario playing out with all the traps I've described fully engaged and operational. You're watching your 401k account drop 30% in 2 weeks. You submit a withdrawal request, fully willing to pay that brutal 40% penalty just to preserve what's left. Your request sits in a processing queue while the market drops another 20%. By the time your request is finally approved, you've lost 50% of your original balance, and then you pay 40% of whatever remains in penalties and taxes. Your $200,000 retirement account yields $60,000 in your hand. And that's assuming your withdrawal request actually gets approved at all. During peak crisis conditions, administrators can invoke extraordinary circumstances clauses that suspend all distributions completely. You're sitting there watching the numbers shrink on your screen hour by hour, completely unable to act, trapped inside a system that was designed specifically for this exact purpose. The banking system is equally fragile despite appearing stronger. In 1929, Bank failures happened because banks couldn't get their money back fast enough when depositors demanded their cash all at once. Today, banks hold significantly more reserves and face much stricter regulatory requirements. But those reserves are completely useless if the payment systems themselves freeze up. Modern banking runs entirely on digital infrastructure. Fedwire for large transfers between banks, ACH for routine payments like paychecks and bills, SWIFT for international money movement. Each one of these systems has capacity limits and can be completely overwhelmed during periods of extreme stress. In September 2019, during a period of economic expansion with absolutely no crisis happening, the overnight repo market spiked from 2% to 10% in a single day. The Federal Reserve had to inject $75 billion to prevent the system from seizing up completely. That happened during a period of relative calm. When real panic hits the system, these networks simply stop functioning. Silicon Valley Bank collapsed in just 36 hours in March 2023. Customers learned Thursday afternoon that the bank was in trouble. By Friday evening, regulators had seized control of it. Depositors with more than $250,000 had zero access to their money until the following Tuesday, when the FIA created a bridge bank to handle deposits. 4 days without access to their own money. For businesses with payroll due and vendors demanding payment, that 4-day freeze was existential. They couldn't operate. Now multiply that scenario across the entire system during a real, full-scale crash. Not one regional bank failing, but dozens of major institutions. Not a few billion in deposits frozen, but trillions of dollars. The mechanical systems simply don't scale to handle that volume. The FDIC has roughly $125 billion in its insurance fund to cover $10.5 trillion in total deposits across the banking system. The basic math doesn't work if even 5% of banks fail simultaneously. There isn't enough money to cover the losses. This is precisely why 2026 will be worse than 1929. The speed is exponentially faster thanks to algorithmic trading. The leverage hidden underneath the surface is dramatically bigger thanks to complex derivatives. And the tools available to fight the crash are already exhausted. Interest rates are already sitting at 5%, leaving very little room to cut rates meaningfully. The Fed's balance sheet is already bloated from years of quantitative easing. Government debt stands at $35 trillion, leaving no room for the kind of massive stimulus programs that saved the system in 2008. And unlike 1929, when people could at least try to save themselves by withdrawing cash and buying physical gold, the modern system has methodically closed every one of those exits. Digital gates, penalty walls, processing delays, legal restrictions, all carefully designed to keep your money trapped inside the system when you need to get it out the most. The 1929 crash took 4 full years to hit absolute bottom, because people had the ability to withdraw their money and wait out the storm in safety. The 2026 crash will be faster and deeper precisely because they can't do that anymore. The crash hasn't hit yet, but if you know where to look, the early warning moves are already visible. Not in news headlines, but in the quiet actions of people who have the most to lose. Corporate insiders, sovereign wealth funds, institutional investors with access to information you will never see. In the fourth quarter of 2024, corporate executives sold stock in their own companies at levels not seen since 2021. Insider selling hit $16.2 billion in just 3 months. These are executives exercising their stock options and immediately dumping shares at 4 times the normal rate. These aren't panicky retail investors making emotional decisions. These are CEOs, CFOs, and board members who see quarterly financial numbers before they're publicly announced, who sit in strategy meetings where real problems are discussed openly. When insiders sell their own company stock at this scale, they're not trying to time a small 10% correction. They're getting liquid before something much bigger breaks. Sovereign wealth funds are making remarkably similar moves. Data from the third and fourth quarters of 2024 shows significant shifts away from U.S. equities and toward gold, commodities, and short-duration bonds that preserve capital. Norway's government pension fund, one of the largest in the world, reduced its equity allocation by 18% during 2024. Abu Dhabi Investment Authority increased its gold holdings to levels not seen since 2008. These aren't institutions that panic or make emotional decisions. They manage trillions of dollars across decades-long time horizons, completely focused on long-term stability and preservation. When they reposition this defensively all at once, it's because their sophisticated models are showing risks that justify sacrificing potential upside to protect their capital base. Then there's the Treasury market itself, the $27 trillion foundation of all global finance. In October 2024, liquidity started deteriorating in ways that mirror pre-crisis conditions from previous crashes. The bid-ask spread, the difference between buying and selling prices, widened significantly. Large orders that used to move the market by just a few basis points started creating 15 to 20 basis point swings in prices. This is the kind of illiquidity that precedes major breakdowns. It means there aren't enough market makers willing to take the other side of trades anymore. People are getting genuinely nervous about holding even U.S. Treasuries, supposedly the safest asset in the entire world. And while all of this is happening behind the scenes, media outlets and Wall Street cheerleaders keep repeating the exact same lines that were used right before 1929. The economy is fundamentally strong. Corporate earnings are solid and growing. Current valuations are completely justified by technological innovation and AI. This time is genuinely different from all previous cycles. It's never different. The fundamental patterns never change. The Shiller-PA ratio, which measures stock prices relative to earnings, stands at 39 as of October 2025. It was 32 right before the 1929 crash. It was 32 right before the dot-com bubble burst in 2000. It's now 23% higher than both of those historic peaks. But apparently artificial intelligence and machine learning justify valuations that previous generations would have instantly recognized as completely insane. The yield curve has been inverted since July 2022. That's now over 3 years of inversion. Every single recession in the past 70 years was preceded by yield curve inversion, typically 12 to 18 months before the actual downturn hit. We're now 39 months into this inversion, well past the normal lag time between warning signal and actual crash. The warning lights aren't just flashing anymore. They're screaming at maximum volume. Here's what makes this particular moment uniquely dangerous compared to any other time in history. All of these warning signs are flashing bright red simultaneously, while the trap architecture I described earlier is fully operational and waiting. When 1929 arrived, people at least had escape routes available even if most of them didn't use those routes in time. Today, the people who can actually see what's coming, the insiders, sovereign funds, and major institutions, they're quietly repositioning their money to safety. But the ordinary investor with a $401,000 and a savings account has absolutely no idea what's happening. They're being told to stay the course, keep contributing to their retirement accounts, ignore short-term noise and volatility. They're being carefully positioned as exit liquidity, the final buyers before the trap snaps shut and locks permanently. History doesn't repeat itself with perfect precision down to every detail, but it absolutely follows recognizable patterns that anyone can see if they're willing to look honestly. The 1929 crash wasn't random chaos that came out of nowhere. It was the mathematical result of too much debt, too much speculation, and people convincing themselves that old rules no longer applied to modern markets. The 2026 crash will follow that exact same pattern with one absolutely crucial difference that changes everything. When it finally hits, you won't be able to do what the 1929 survivors did to protect themselves. You won't walk into your bank and withdraw your life savings that same afternoon. You won't sell your investments without facing crushing penalties, endless processing delays, or potential complete suspension of your ability to access your own money. You won't have the freedom to protect yourself and your family because the entire system was specifically designed to prevent mass exit. Every rule, every regulation, every processing delay was built for this exact scenario. Remember that businessman I told you about at the beginning? The one who walked into his bank in September 1929? He survived the crash and thrived afterward because he acted before the crowd realized the danger was real. He didn't need anyone's permission. He didn't need to wait for processing periods or pay penalty fees or hope that systems wouldn't freeze. He saw the risk clearly, took his money out, and got himself to safety. You don't have that option anymore. Those exits that saved him have been systematically sealed shut. But you do still have choices available to you right now. You can acknowledge that these traps exist and work strategically within the constraints you're facing. You can reduce your exposure to penalty-locked retirement accounts by redirecting new contributions to accessible savings accounts, even though it costs you some tax advantages in the short term. You can build substantial cash reserves outside the retirement system, accepting the tax burden now instead of risking total loss later when you can't access anything. You can pay very close attention to what corporate insiders are actually doing with their own money. When smart money is selling their positions while simultaneously recommending on television that you should buy and hold, it's absolutely worth asking yourself why they're doing that. Or you can do what the vast majority of people will inevitably do. Trust the reassuring statements from experts. Keep contributing diligently to retirement accounts you won't be able to access during a crisis. Assume that this time really is fundamentally different from all of history. Believe that algorithms and artificial intelligence have somehow eliminated the business cycle permanently. Trust that central banks can prevent any real economic pain. Assume that markets only go up as long as you hold long enough. Every generation thinks they've somehow evolved beyond history's lessons and that old rules don't apply to them. The generation of the 1920s thought that industrial technology had created permanent prosperity that could never end. The generation of the 1990s thought the internet had eliminated old economic models forever. The generation of the 2020s thinks artificial intelligence has conquered risk itself. They're all exactly the same thought wearing slightly different clothes. People who survive major crashes aren't necessarily the smartest people or the most connected to inside information. They're simply the ones who recognize the pattern before everyone else does, who are willing to look paranoid and overly cautious while others are celebrating, who understand that protecting capital matters infinitely more than chasing the last 20% of an overextended bubble. The traps are completely set and ready. The warning signs are flashing brighter than they've been in decades. Insiders with actual knowledge are quietly heading for the exits, while telling you on television to stay fully invested for the long term. The real question isn't whether the crash is coming. That's already decided. The question is whether you'll be desperately trying to escape through exits that no longer exist, trapped behind digital gates while your wealth evaporates in real time, or whether you'll have positioned yourself safely outside the cage before it locks permanently. Your grandfather back in 1929 could grab his money and run to safety. You can't do that, not anymore. The system won't allow it. But you can still prepare yourself for what's coming if you act now, before the crowd realizes the danger is real. Because once everyone tries to leave simultaneously, the gates close automatically, the systems freeze completely, and the wealth you thought you had becomes nothing but a number on a screen that shrinks hour by hour while you watch helplessly, completely unable to act or protect yourself. The choice is entirely yours to make. But the timeline is closing fast.